Welcome back to the Capital Mindset Show, everyone, or podcast, better said. This is the, I guess, second iteration of its kind, but this time in podcast form. So you'll see this on Substack, YouTube, and Spotify. And I'm here with a valued member of the community, a longtime member of the community. Do you want to introduce yourself? The floor is yours.
Yes, I am Bacon Memes. Just a disclaimer, like I'm kind of on the more incompetent side of
He's
things.
modest. He's modest.
Yeah. So yes, obviously not financial advice, although I don't think I constructed my questions as financial advice. This isn't a gotcha interview or debate. This is just hopefully a little bit of value for how capital mindset and you specifically, Fabio, think about some concepts, some specifics, and hopefully, yeah, it's just good content for everyone involved.
Awesome. Beautiful. Okay, so the way this is going to work is Bacon is going to ask me some questions, and we're going to go through it and have a conversation about it. And hopefully, you, the listener, and Bacon here can find value of some sort in the content. And let me know down in the comment section below if you want to see more of these. Wherever comment section is available to you, if you're listening to this on Substack, I don't think there's a comment section on Spotify, but you can find yourself going to the YouTube version of this, and you can leave a comment there. So. All right, the floor is yours. We may begin.
Alrighty. So, yes, first topic, I guess, in general would be methodology, and under that we would ask, or rather, I would ask how much time would you say you spend researching in any given day or any given week? And also, how do you research as far as your thought process in researching anything from stocks to macro to what have you?
There was a time where I spent perhaps the good part of 8 hours per day, the good part of it. And I'd say in current time, I would spend probably on a daily basis, including weekends, about 4 to 5 hours per day now. So it's a little bit more tamed. And it's, I know it's going to sound crazy, but a lot of people can probably relate to this. To me, it's even fun. So I don't consider it working or anything. It's actually like what I would do in my pastime otherwise. And I can be doing it, just um, I know this is going to sound bad, but even listening to an earnings call when I'm on a run or at the gym, yes, in fact, I would sometimes do that. Not all the time. I'm not a freak. But genuinely, I enjoy the work, and so I don't really find it as something that uh, I don't find it as like something that's tedious. So after I conclude my daily labors currently, which currently my daily labors don't really have much to do with researching equities or anything like that, more so just reviewing how other people are researching equities, stuff like that. Afterwards, I will begin my own research and try to figure out what's best for me. So, and you asked about buying and selling, or no? Or just
Not yet,
research?
not yet. That
Not
will
yet.
be coming up though. Just out of curiosity on the line of research, what sort are there any sort of like platforms, databases, websites, or tools that you would recommend in
So,
general?
an aggregator of information, I assume, because you could always go to the company that you're researching for a lot of good information. The 10K is going to have at least everything that the management team has, for example, laid out as far as risks go. They go excessive, right, to cover themselves, but in there, there's going to be legitimate risks. And so that would be something to kind of ponder upon. So, I know that it looks like a lot of words and stuff, but inside of there, there's a lot of useful information. So, but that's the I guess the obvious. What people want to probably know is a good aggregator, a one-stop shop where you could go in and find out a topic. Well, for one, I gotta say, finding a good community where there's a lot of like-minded individuals goes a long way. I think you could attest to that, where you have multiple eyes and ears, not just your own, and then you can kind of gather information, collaborate information, share information. There's going to be people who find things that I didn't find, and then when I put the two pieces together, I get a fuller picture. And as far as websites go, so there's a community aspect. Maybe you have friends. Like if you're listening, if you're not part of a community, maybe you have a group of friends. But as far as a website goes, I there's a lot of bad ones, but there's some that are good if you know how to filter through it. And I'll be honest. So Seeking Alpha seems to be a pretty good one if you know how to filter the good from the bad. Because there are some articles that are, and then some articles that are actually quality. So I think another YouTuber by the name of Jay Naga you're familiar with, he said that investors need, there's a certain threshold of information, of knowledge, that once you get past that, you get pretty good at determining who kind of knows their stuff or who's kind of winging it, or who's just kind of putting things together. So after that threshold is passed, let's say if you're an amateur accountant or amateur finance bro, right? At that point, I'd say that you could probably get a good idea of, okay, well, this article is well researched, this article is not well researched, and I'd say that on the surface, Seeing Alpha does a good job at kind of giving you an introduction to a business, to a company. But if you really want to get to know the business, you got to go way further. YouTube is a fantastic source of information for some things. And in this case, for example, if the CEO has an interview and it's like an hour, 2 hours long, why would you not want to watch that? Just to see what that CEO has to say gives you a good glimpse. And you see how I didn't say, for example, go watch a finance YouTuber.
Yes. Yes.
Yeah, notice how I said that. I said YouTube, but for finding, for example, interviews with the CEO, interviews with the portfolio manager, interviews, etc. People who are taking it to, I think, the next step. They're very boring. I get it. They're not going to get, sadly, right, the CEO interview won't get as many views as perhaps the YouTuber talking about their stock. But I think overall, though, that's going to be a good place to kind of gather, let's say, qualitative information, not so much on the quantitative side, but qualitative. So, you get a feel for how the CEO thinks. And why is that important? Well, he's managing your capital, right? He's the steward of your capital within that business. And so you would hope that you're kind of in agreement. I'll give you some examples if anyone's curious. So if you're interested in Brookfield Asset Management or Brookfield as a whole, there are plenty of interviews, of speeches where the CEO is talking before. I think one is in front of Google, and I think that one's 2 hours, 3 hours long. Maybe it's an hour, but it's long. And he talks about his principles, his ideas, his thoughts, his process for how he goes about finding an investment. Then you have the CEO of Markel, right? You want to know how the co-CEO of Markel thinks? There you go. YouTube has it for you. And I think he's also speaking in front of Google in one, and he's speaking in front of another conference at another. And then, Warren Buffett needs an introduction, et cetera. But Warren Buffett for the CEO of Berkshire Hathaway. So people have seen his videos probably, even if they're interested or not interested in investing in BRK. But yeah, YouTube.
Okay, so one of the questions, then this one actually got proposed by someone else, was what would you say, like your talents and abilities? What rough percentage would you say to your skill set is academic, mental, and emotional, like temperament or management, and professional experience? And then there's a follow-up after this one.
I'd say that, geez, I'm giving rough estimates here, but the academic side was perhaps 20% of it. I was a good student. I was always a good student, got good grades. My overall GPA, for example, in finance and accounting was pretty high. And but as far as like the life lessons, it gave me a good foundation, absolutely. And through my academic studies, I got to meet a lot of interesting people, because I feel like this is kind of anyone who's in this position now. If you're pursuing your studies, don't do the bare minimum of your class. Go above and beyond. The class is only there for the foundational skills, the foundational aspects. If the professor is passionate, and hopefully, that is a luck of the draw, absolutely. But let's say you have a professor that is passionate about the topic, they're going to take notice of your passion, and they're going to feed off of that. And so you want to show that passion if you are passionate. You could just be lying to yourself and you're not very passionate about this. But if you are, go above and beyond the class. And for example, one of my professors back in the day, he told me that what you're learning here is the basics, right? And for some people, it was very difficult to do the basics, but you're learning the basics so that one day you go out there and you create your own metrics, for example, that you look for, because you're thinking outside the box. You're not thinking on the on, let's say, the past. And that's either said than done, because you could just be creating crap, you know?
Of course,
It
certainly.
doesn't mean you created something good, but that's the point. You got to kind of just get out there and hopefully fly on your own. So that's one thing about the academic side. So I describe probably a 20%. And then as far as the mental or emotional temperament, I'm a pretty relaxed guy. I feel like everyone who knows me as kind of more the very relaxed type of person, doesn't really stress too much, even if the workload's insane. And some people look at my workload now and they think it's absolutely insane. But for me, I'm kind of just, just chilling. And I'm very much in a good place in life. And I feel like that helps a lot. A lot of the past work has a lot of fruits in the future. And I always feel like, for example, things kind of, if you put your best effort, things will work out. Maybe not in the way you think, but they'll be okay. So having that mentality also helps with investing as well. Of course, the asterisk there is that doesn't mean I have the golden ticket to just be a moron. But
Certainly.
exactly.
Yeah.
I don't want someone to hear that and says, "Oh, well, he thinks he can just degenerately buy some random call options and everything will work out." No, 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 no. But it's kind of all part of the bigger picture. And I describe to that another 30%. And then 50% is probably professional work experience. 50%
Oh,
is definitely work experience.
all right. So the follow-up for that would be based off the percentages that you've given and your self-reflection. Like, do you think the average person, given their, average like day, could achieve like at least somewhat comparable results given enough time? And how much time do you think a person would need to allocate, try to get to that level?
So the average person definitely can, because I'm saying the average person is, well, let's backtrack that. Actually,
Yeah.
I'm going to say
Yeah.
this: the average person will not. And I'm saying, for example, if you're already in the group of people out there on the internet that is fascinated with this topic, you're already not the average. You're already not the average person. The average person does not care about the things we are discussing here today. The average person cares about other things. So you're already not the average. So technically, the question is dead on
Yes.
arrival.
Yeah. Kind of is.
But let's take this subgroup and say the average of that subgroup, which is perhaps what the spirit of the question is about. I'd say yes. The average person of the subgroup can thrive, and we'll kind of begin by very basic strategy. I guess we can save the basic strategy for later, unless you want to talk about it right now.
We can. We can. I can adjust, as time goes on. That's not a problem.
So the basic strategy that one can employ, that actually I think is quite responsible, is doing a 95-5 strategy. 95 index funds, broadly diversified index funds, to match the market, and then that 5% portfolio to try to achieve that extra return. And that's a more conservative side. Some people would say, okay, 90-10. So 90 goes into the broadly diversified index fund, and that matches the market. You're going to outperform typically most fund managers because, well, if we get to that, a lot of fund managers invest with a hand tied behind their back. It doesn't mean that they're morons. It's almost like the limitations of the trade. But also there's a lot of other limitations in the professional realm of investing that we can also talk about. As far as like funds go, and why there's some funds that have overtly an advantage over others. But let's say, for example, if the average person can just do that simple strategy, and it's not saying they're going to outperform, because they could, that 5%, that 10% could be allocated poorly. But at the end of the day, the risk that they derail their investment, it's fairly low, as long as, here's the key word, as long as the market achieves a regular rate of return that it has in the past. If that doesn't happen, that's a different story altogether. But assuming that it does, that strategy should do well for the average person. And they may, in fact, find that they are actually pretty good allocators with that 5 or 10%, and that could boost their return potential over the lifetime of that person. But you're probably also asking about that person who says no to all that and kind of goes mostly with individual stocks, I assume, correct?
Yes, yes. I think that's the spirit of the question that got brought up as well.
So that question, the average of the subgroup of people, wow, I would say that no.
Okay.
Um, the average person will find it very difficult for a variety of reasons. One of them being temperament. Temperament, for let's say, while I ascribed only a 30% importance to, sorry, credit. I gave it credit, but in as level of importance is perhaps even more important than your intellect. Way more important than your intellect, actually. In fact, I find there's a lot of people who aren't as intelligent as others, but they perform better, or they're better investors, or they're better businessmen than the one who is more intelligent. Because some of us think that, oh, that person's more intelligent, therefore they're probably really good allocator of capital or a business person. And no, that's not actually the case. It's really a lot about being able to handle high stress situations. And nothing is more stressful than watching a position that you own go down, let's say 30, 20, 10% in whatever time frame you want to picture, and then figuring out what to do at that point and do the right thing, right? And then take that for, let's say, to the extreme and say that's not even your money anymore.
Oh no. Yeah.
Precisely. Can you imagine
Yeah.
how stressful that can be?
Very. Absolutely.
So it takes a certain kind of person, I would say. But can someone work hard to get to that point? Can they train themselves? Yes, if I think they get a good, let's say, community behind them. I think community is a huge factor of importance because it is very different. And but this is the problem. And I think you might have had a follow up question to this, but I'm going to assume you did. Um, so some communities are not good. Some communities are good. How do you know? Well, yeah, that's a tough question right there. But there are some communities that can encourage bad behavior, or some communities that can cause, let's say, confirmation bias. Those are the bad ones. Then there are communities that add to the flavor and will counter your points, counter your feedback. And you want to find that community, not the one that's going to say yes to everything that you say or yes to every idea that you put out. You want to find there's our communities out there. You want to find them, the ones that are going to push back on your idea and say, Bacon, did you think about this? I'm not sure about that thesis. Uh, uh, this company's probably actually better than that one. Well, you're not thinking about this new technology that's going to overthrow this legacy technology. So that's a good part, I think, of the success of an investor is kind of having that community. The community could be small or big. Some people have, like, for example, Warren Buffett has a community. It's called Charlie Munger, right?
Yeah.
So
Oh
it's a one man community, or he has more than that, but you get the
certainly.
picture.
But yeah.
Buffett has a community, is what I'm trying to say.
Hmm.
So
Yes. Support network is one of those underrated things for sure.
precisely.
Okay, so here's one question on methodology. We know that you've used DCF or different valuation methods. Some said, others not so much. Would you say a valuation method is enough though? Um, and especially like the concept of Keynesian beauty contest when it comes to individual stocks or say even plays on an index. Like, is there a way to try and capture that a market is always forward looking? Like, for example, if we calculate like cash flows or profit or whatever metric like going into the future, like 5 years from now, and we get environment right, like from here to 5 years from in the future. But if forward guidance all of a sudden, at that fifth year, is horrendous, like we could definitely see price action crushing any valuation metric. Like is there a way to capture it?
Is there a way to get ahead of the market and predict what it's going to do? Is that what you just asked?
Yeah, thereabouts. Like is there yeah like based off of like valuation metrics that you've used, are there ways to modify things to
Well,
try and
the,
get one more step ahead?
trying to dissect that and break it up into pieces. The part about the market for is forward looking is absolutely true. I think on average it's like 6 months. I believe that when they did
Yeah.
studies, it's estimated. It's estimated that the market's looking forward about 6 months. So what's causing that is the huge players, a lot of the fund managers within the market. That's as pretty much as far as they're looking at, by the way. So where the individual investor, and where I was kind of hinting at before, where some funds or some entities have the advantage is that they don't have to look 6 months whatsoever. And see, that's the wisdom that I think people would hopefully like take a pause when, for example, the likes of Buffett or even other investors, but I'm just using Buffett's name because he's the most well known. But a lot of them have said the same things, because I think that's like a base principle. It's about what's your time frame, and your time frame needs to be the only way you're going to get an edge over your competitors who have a crazy amount of information over you is adjusting your time frame. And some people use that as a crutch or an excuse for underperformance. That's a bit of a problem. But going back to kind of what, in the spirit of how Buffett and all these other investors tried to tell retail investors, it's really about worrying what the business will do over a very long period of time rather than what it will do over the next 6 months. If you think, for example, that let's use a bunch of stocks that have shown us their true colors here. Like, let's take PayPal, Square, etc. Do you really think that they were pricing in the next 5 years of the same thing, or was the market kind of just pricing in the next forward 6 months, and then it thought that reality was going to continue for forever into the future, and then all of a sudden the reality changes, but oh, who could have predicted that demand destruction, etc. Why would it fall so much right after? Well, it's because the market is forward looking, but it's not forward looking like 10 years. It's forward looking to the reality of the present by maybe about 6 months to a year. And then so there, again, where why that kind of has shaped out is perhaps because the largest players in the market, the real market movers, that's how they think, because that's how they're compensated. So the incentive is there, and you will find, I think, plenty of family offices and plenty of not, right, but plenty of family offices that are performing infinitely better than some of these funds, because they have that massive advantage where, one, they don't have to really care about what the investors think because they are the investors. And two, that allows them to kind of be very open-minded about their time frame. And usually, more often than not, that's far longer than said funds that we just discussed. But now you asked a question about a model. What was that again? A DCF?
Yeah. Like, are those, do you think that those are sufficient tools, for valuation, and for,
The
just capturing things?
The big fundamental issue with the DCF is a DCF is just, I would call it another umbrella terminology. There's like a basic principle behind the DCF, discounting the cash flows to the present value to determine, based off of your forward assumption, to determine what value you should be really paying for an asset. Well, here's the problem. So when you go through university, you'll create a couple DCFs, okay? And I exaggerate, there's not literally a million, but I say that for a reason. There's around, let's say, an uncountable or an unknown amount of ways to create a DCF model, and not all are created equal. There are big fundamental problems with like the basic DCF. For example, the ones that you see a lot of these YouTubers use, they use a DCF that I would probably only normally use if I was acquiring a company within a very short time frame, and maybe the entirety of the business as a whole. I wouldn't use it for, let's say, an individual stock. And it relies upon a very grave assumption that I would never use in a model that's for 10 years out, ever. It makes no sense, because I can't predict what let's say, the terminal multiple is going to be in 10 years from now. That makes no sense. But there is a place for that analysis. There is a place for that. There's a reason why it exists, and there's a reason why it is used. But not for something that you're like, okay, I'm going to create a 10-year model. And by the way, in IB, a lot of models are basically based off of the standard 10 years. So that's another thing. But a terminal multiple, I think, has a big flaw in that. But anyways, I feel like the mistake that retail investors will make is they'll use these models as a crutch. And the problem then becomes, and I think a lot of you in the community have figured it out, you'll start to put in assumptions that make it work, and that even defeats the purpose of it. So garbage in, garbage out, as some might say.
Certainly. Um, just out of curiosity, do you short?
Very rarely.
Very rarely. Is there like a favored like method or approach for you on shorting? Like,
So I
like
would
are there
prefer,
specific things you like? Hmm.
I don't I don't always use options, but in this case, I would prefer to use options rather than just shorting the stock. Although, and specifically buying put options. Although, if we get to the options part if there's questions about options, I'll basically talk about how, no one is a genius with options. There's very little opportunity oftentimes in options because it's usually more often than not quite priced in. So there are some names that I've found success in options, but for example, I'm just going to cut to the chase for this one. I don't know if you had a question about this coming up, but with the biggest names where everyone's paying attention to, I don't even attempt it. I don't even attempt it. I don't play with the pie. Like for example, if I'm trying to sell calls, covered calls on a stock, I would not do that with Alphabet personally. I don't even play around with that. If you noticed on the YouTube channel and within the community, the ones that I have done covered calls on, has anyone in retail ever heard of those companies?
Good point.
Probably not. So
Yeah.
there's like pockets of opportunity, but you'll notice that there's not even that many option. There's not a lot of optionality in terms of the time frame on those options. If you actually go to sell some covered calls on the stocks I did, like Unum and AGRD, for example, this year, if you had like let's say participated or seen the options that you could have for in terms of time frame, you're very limited. There's not really much interest. The market's not massive for those guys. Um, but for example, with Alphabet, no, I'm not going to play that game. I feel like it will cause me more harm than good to do that. So I don't play around with that. But yeah, for as far as wrapping up on the short answer, I don't do that usually. I try to find also if there's an instrument out there, like an alternative instrument. And I'm going to say the name of the instrument because now it's too late. No one can follow me in. I'm done with the trade, and I didn't even want to mention it on YouTube ever. I only mentioned it even a couple times on the call. I know that there's another YouTuber that actually he's in the community and he did mention it on his channel, but I think responsibly as well. And that was TTT, which was shorting the U.S. Treasuries, and that actually was a good return. I didn't sell it at the top. We can talk about decisions for selling, and I'm still happy with when I sold it, but I think it roared like another 30 or 40% from when I sold. But in that case, that was like an instrument, a product that exists out there to capture a specific movement that I think was going to happen. So I try to see if there's that pun intended option out there, and as far as like shorting, I know that, for example, we discussed these two companies that would short if I had a gun to my head and I was forced to short, which would be, Credit Acceptance Corp and Ally Bank, back when we were talking about it, to kind of capture the movement of subprime auto lending. But yeah.
Oh yeah, yeah, yeah. Actually, yeah, that's a great segue. Like, how much time planning and like, what's your preferred methodology for entering and exiting a position?
Wow, these are great questions because these are like the art side of things. But entering a position really, again, this is like I don't have like an analytical answer. I don't follow an algorithm that tells me when to do it. But it's really a lot on personal sentiment I have towards a specific business. So I create for myself like a range of buying windows. And I do so because I learned young, thankfully, that creating a stagnant line in the sand is, for me, not going to be a successful strategy. Because for me, that's like saying, I know that that's the bottom. I know it for a fact. And I admitted to myself early on that I don't know when the exact bottom is. I don't know what the market's going to give me as an opportunity. So I felt I'd rather create a window in which I would be buying slash selling rather than having a specific price where I'm buying it all or selling it all. So what I'll do is, and it can take a while, but as long as it's within that window, and let's say for buying, as long as the thesis remains, and I will always revisit the thesis while it's in this buying window because I always have to reassess and say, well, am I wrong? Is there information I'm not considering? There's no minimum per se. There's no defined minimum, but there is a maximum. So like with Netflix, there was a maximum price that I was willing to buy it, where I wasn't going to buy it above that price.
Ah,
But it's a pretty large window, and you guys saw it basically evolve on YouTube. There was a price where I started buying, and it was significantly higher than where it got to, but I bought little chunks, right? Little baby chunks. And I'm doing this now with a new position, which I won't mention here right now because I'm waiting for a video on that one. But you know which one it is that I bought
yeah.
the starter position in. So
Yep.
it could go much lower, and I will take advantage of that. And I'm always happy to have the dry powder and say, oh, well, here you go. I'll take those shares. And it's a really good feeling. I feel like it's also mentally healthy for me. It's not like if I were to have a defined price point and I wait for it to get there, but it never gets there. Well, then I let it, kind of run away. So I like to buy into it, and if it runs away from me at that point, it's like it's okay. I captured it, and I didn't buy the whole thing, but I'm still happy. I got the allocation. I can just there's always another opportunity, so I'll look elsewhere, and that's happened to me a couple times too. But yeah,
Yeah. Oh, alrighty. Okay, so I think we got most of the methodology done. Now onto the fun topic of portfolio construction and risk. I'm throwing in an audible here. Like, how would you define and measure risk when it comes to your portfolios or portfolio in general?
that's a great question because academically, that's usually measured by the standard deviations.
Yes, yeah, yeah, and I feel like risk is a word that's defined financially or academically in a insufficient way.
Yes, I throw that away. I think in the practical world, in the real world, I would define it as permanent capital loss. Permanent capital loss. What people will often find, especially if they come across a lot of wealth, is gaining wealth is not the most difficult part. It's keeping the wealth. It's very difficult. Um, so once once you've made like let's say a good chunk, and then you kind of know or have that similar mindset, and you can build upon your past laurels because you've already kind of got to that point. Then you start to really appreciate the how difficult it is to actually maintain it, both from a let's say social standpoint, because a lot of people will they'll make a lot more money and then they'll spend a lot more money, right? Because they just get I don't know they don't think about these things. And then there's also where do you park it, right? Because now okay, let's say it kind of gets to that discussion I have. Let's say we have a hypothetical inheritor of $1 billion. So there's a young man, 18 years old, and he inherited $1 billion. Well, the typical mantra is that, oh, you're young, you can afford to take risks. No, 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 no. That is not true for this young man. This young man cannot afford to take on risk. Why? Well, let's ask ourselves the question. How difficult is it for this young man to generate $1 billion based off of their skill, or et cetera, or whatever? We'll find the answer is quite difficult. And there's a sense of urgency to maintain that capital, to maintain that value. The mantra where that applies is the young man who is starting from nearly zero, nearly nothing, and they can afford to perhaps take on a tremendous amount of risk because for them, there's not much to lose, right? They can build their portfolio from nothing. Although I would say that, okay, well, within reason, like, I wouldn't call the risk of, um, gambling or, gambling in the stock market. Just, I would hope that that young man is responsible with the amount of risk they take on. But I will define risk as permanent loss of capital. The man with the $1 billion cannot risk a permanent loss of capital as much as the young man who has $1,000 portfolio, but he's able to save $1,000 every month to invest in the stock market. So that $1,000, while you don't want to lose it all, it's not the same level of urgency as, the $1 billion man, let's say, goes to 500 million. Well, what's the likelihood that man can generate 500 million? There's very few people on this planet that have a skill set that can generate $500 million. I gave you an extreme example of a billion on purpose to
Oh yeah,
highlight the difference. But
certainly.
I
Um,
think the construction or risk profile of the portfolio should be reflective of your own individual circumstance and the amount of risk that you're likely to take on. So your age would matter, right? I think for someone who is of the older generation should really focus on maintaining a sense of stability, because they probably maybe live on their investments. So a good portion of their portfolio should be cash or bonds, etc. Things that are not going to generate high returns but maintain their value. And when I say bonds, by the way, short duration bonds, because
oh yeah, yeah.
yeah. But
Shorter term T-bills as close
yes,
to cash as possible. Yeah.
precisely. Yeah.
Um, yeah. So is there like a preferred metric or way to measure risk that you think that each case should consider, or no?
Uh, the, so for equities, the thing is, because the market, it's very difficult for us to know what a company is going to do.
Yep.
I would argue that an index, the reason why an index is very much, it's lower risk. It's pretty much as low risk as you can possibly take, like a broadly diversified, low cost index fund,
Yep.
because it's capturing the entirety of the market, not and it's not exposed to an individual, and it will be constantly adjusting to the winners. So that is probably going to be the best bet for equities. But for example, let's take bonds, right? Let's go to bonds or preferred stock. There, you're going to have a less likely amount of permanent loss of capital, because it's obviously higher up on the food chain as far as who gets paid out first when something goes wrong. So with bonds, I'd say, like we say, the risk-free rate. Some people have a dispute by that statement, but the risk-free rate, because obviously, I think actually there's reasoning behind that to agree with it, because if all of a sudden it's not the risk-free rate, and let's say it truly does become something that is of risk, our whole system collapses, like within that year. But I would look for things that have a very low risk or low probability of permanent loss of said capital. So I don't think you're going to lose your money if you lend to Apple 5 years from now. So a 5 year bond, if you were to buy like a 5 year duration bond for Apple, if you found one or whatever, I don't think you're going to, like, for example, I would consider very low risk. Buying a CD, the very low risk. Buying a treasury, very low risk. But finding an equity that offers that, man, you don't know, because at the same time, you say, okay, what about an electric utility? I mean, those are government regulated, etc. Well, there was one in California well, that's an electric utility, and look what happened to them. They actually, I think they collapsed, and you had to I think they went bankrupt, and they were back to being public. And I think at that point you should have bought, but everyone else who owned it before was wiped out, and that was a publicly traded company, and electric utility, and everyone needs electricity, right? It was one fire wiped them out. So there are things that we sometimes cannot predict or fathom. I would never tell someone that an equity is without risk. So
For sure. Certainly. So when it comes to portfolios, like making a portfolio, I know behind the scenes that you can produce or construct portfolios with very, very different objectives in mind. So like, what's your approach to making a portfolio? Like, what are your priorities and approaches?
okay, so again, this is going to be more on the art side. The academic side will say, well, you want to have the best risk-adjusted rate of return. You want to have some participants that have, let's say, uncorrelated assets, so that and there's a benefit to that, right? So when you have uncorrelated assets, when one is going down, the other one could be going up or neutral, and that also helps with you within a variety of ways. One, you could rebalance at that point, and there's an immeasurable amount, which we discussed actually in the voice call the other day, which is psychologically, you could feel a little bit more relaxed, because while the rest of the market perhaps is let's say crashing, and then you have a bunch of uncorrelated assets. Some of them might be doing really well, the other ones are doing really poorly. You're probably going to feel a little bit better than the guy who's 100% into correlated assets and they're all going down at the same time. But vice versa, if they're all going up, that person's going to feel great. So portfolio construction really will depend on the person. It's about suitability. It's about and like I have a friend he's a financial advisor, and so with his clients, it's very much about that. What are their goals, aspirations, age, etc., income level, and kind of constructing one based off of those parameters, and making sure that it's fitting their needs, their specific, unique needs. So that's very much an art. It's not so much a science. There's no formula where I grab all this and I plug it in and boom, it just gives me everything I need to buy. But I'll give an example for myself. I think I do have positions that play on different scenarios, and I like to do that. I like to find, well, on a bird's eye view, my philosophy is I like to buy assets at prices I like, and that's it. Keep it simple, stupid. Like I follow the KISS philosophy. But that being said, I have, let's say, theories that I want to play upon. I have thoughts that I want to express via, let's say, the market. And I want to capture that in some way. And where if I think that might happen, I figure out, okay, well, how can I capture that return of that, event occurring? And that event may or may not be entirely correlated with my other stocks. There may be scenarios where they are correlated or where they're not correlated. Okay. What I mean by that, I'm butchering the word correlation there, but what I mean by that is they may move up together, may not move down up together, not in the literal correlation. So I'll give an example with, I'll just say it, my bonds, right? So I'm purchasing bonds. There is a scenario in which my equities move up in line with my bonds, just like how recently, where historically they're not correlated, bonds and equities. And that's actually surprised a lot of people when all of a sudden they seemingly were basically going in the same direction, equities going down and bonds going down. I would say that it really does depend. When people start to get surprised by those things, I feel as though it's because they're following the textbook too much. They're trying to notice or follow a pattern, and I feel like life is more about the nuance of the situation. The textbook is great. The textbook is how you learn the basics, but then application in the real world goes beyond that. I think it requires a lot of thinking outside the box. So, for example, I feel like and actually the textbook does a good job actually explaining this, but people forget about it. There's multiple ways we can get inflation. There's multiple ways we can get deflation. And everyone kind of, when you see, at least talk to the average person who's, let's say, obsessed with this topic, they forget that because it's easier for us to think about there's only one way inflation happens. That's money printing. There's only one way deflation happens. That's, the value of the money goes up. There's only one way, instead of thinking there's many ways. Or like, let's say, again, I have this bond exposure. There's a scenario in which my bonds go up, my equities go down. There's a scenario in which both my bonds go up and my equities go up. And see, like, it's more complicated. I wish it was simple. And just like how people say, well, the textbook says, well, the Federal Reserve, when they do X, this should happen. Oh, no, because I wish it was that simple.
Certainly.
But yeah.
Certainly. Yeah, you covered a good amount on portfolio construction. I just I guess like for like low fee, passive index fund people, like are there any special considerations that you'd mention that you think like that people are blind to maybe, or like a spot that they haven't seen with that strategy?
The strategy is entirely dependent on the assumption that the future will be like the past. But and that's my one caveat. So there are so many countries on this planet in which that is not a reality. We take it for granted that our markets grow. We take it for granted. I think that and like, okay, the thing is, imagine the frustration with that being the case, because the people who follow that strategy, they don't know any other strategy. And of course, rightfully so, they see individual equity investing as very risky. Rightfully so. Just as, let's say if you were someone who's buying a small business or getting involved in a small business, yeah, that's risky. Some people don't like to take on that risk. Some people are risk adverse. And hopefully the market finds solutions for those people to still participate in some of the upside. But it assumes that the United States will just continue to be the same as it once was. And there are plenty of countries, plenty of continents where that just simply isn't the case. We can't take for granted that we will just produce tons of wealth forever. There can be a time where we maybe don't we do things to harm the goose that laid the golden egg. Plenty of countries have also done that throughout history. And if that were to happen, I would probably understand the frustration of the index investor who, let's say, hypothetically, for the next, because people point to the last 100 years. That's usually the example they give. Like, index funds return on average 10% per year, looking back from this time frame. And then you say, okay, well, that's really dependent, and we're just talking about the United States. Can we look at like other countries? How have they done? Well, not the same. So,
Certainly.
yeah, that's the. But then you ask, well, what's the alternative for them? They don't want to take on outsized risk, and they maybe shouldn't, because more than likely they're going to fail. Well, the answer is there is no answer.
Tina,
It's a
there is no.
privilege. Yeah.
Yep. There is no other alternative, Tina.
No, yeah, it's a privilege to live
Yeah.
in a time
Hmm.
where there's a tremendous amount of wealth creation. For most of human history, wealth has been something that only the few can accumulate. And even in some countries where, we can take, Cuba or Venezuela now, modern day Venezuela, that's now very much a reality that true wealth is something only very few can accumulate. And that's, again, basically the state of most of human history. So our capital markets are quite literally the first time in a very long time, or actually maybe throughout all of history, where the average person has the opportunity to participate in that economic engine. But that's not necessarily the normality.
Alrighty. From a like, at what point does with a portfolio should a person consider when they're too heavy one sector, one industry, like speculation or like a hypothetical. Big tech names end up having price action that keeps falling. We're talking right now on you know Christmas Eve 2022 for time of reference. But yeah, like suppose someone starts just buying those names at really attractive prices. Is there a point where being too heavy one sector or industry is a detriment and maybe rebalancing is a better idea?
Uh, the answer to that, from my opinion, is that will depend on the person and their temperament, because
Ah,
you shouldn't. I think Buffett's actually spoken on this fact too. Why why are you rebalancing just for rebalancing's sake? The probability that you're then going to be successful in doing that is not going to be the highest. Like, if I force you right now today, and I say you have to buy and be successful at it, right? That's the key word. Be successful at it. Uh, all these sectors, and you must pick stocks in all these sectors, because we want diversification, and I'm forcing you to do that. And I don't even care that one sector is a little bit overvalued right now or not, and we don't know that. Let's say we don't know that, but the probability that you're going to be successful in doing so is a bit more difficult than if you kind of stick to something that you're very familiar with, very comfortable with. But that's the big asterisk right there. Very familiar with, very comfortable
yeah,
with.
yeah.
Um, I know someone who, for example, and this is a good friend of mine. He works in the oil industry, oil and gas industry, and he's a petroleum engineer. He was plowing for the longest time. For the longest time, he was plowing his entire investable income into oil and gas names, all of it, right? Literally all of it. He didn't diversify whatsoever. And he was the one always telling me, he's like, Fabio, there's not enough capital capex investment. Fabio, there's not enough capex investment. Fabio's not enough capex investment. And there he said there will come a time when the market realizes this. But I'm gonna buy until the market realizes this. And 2020 happened, right? And then
Oh
so I'm
yeah,
like,
yeah.
I'm messaging him. I'm like, my gosh, what's happened to you? You know what? He had the best mentality about it. You know what he did? You can guess.
My guess is he exited with profit and rode off into the sunset.
Oh, no, 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 no. This is 2020 when it collapsed, when all the stocks
Oh,
collapsed.
my guess is he bought more. That's
Oh
my
my
guess, but
goodness, he bought way more. He
yeah.
said, Fabio, I don't have an emergency fund now. I'm like, whoa. But he works in that field. I'm not going to say what company he works for, but he works in that field. He got stock-based compensation as well for that company that he worked at. And then he was buying up the shares of the other ones too. And he was buying a ton of them. The only one he kind of avoided was British Petroleum, by the way. So that gives that one away. He doesn't work for that company. But
Yeah.
he was buying a lot of the American oil companies. And gosh, like again, he was a good source of information for at least kind of building out my position because I had a position as well. And to this day, I think now he's done. He's done buying them. Fun fact. So if the audience is wondering that, he's not buying right now, and he's just grabbing all the dividends that he's achieving. He has yield on costs, by the way, that are absurd. Okay, absurd at this point. And he can retire. I can tell you for a fact he can retire today just off of the dividends from all these entities. But he's grabbing all that and he's actually right now deploying it into some big tech names. So he's diversifying. But
Ah,
throughout that period, he was so confident in this play that he even told me, he's like, well, I don't know these other businesses that much, and I can't agree with their valuations right now. And this was, 2018, 2019, 2020. He was like, he's making good money. I'm going to grab it. I'm going to buy these stocks. And he lived I can tell you, he lived like a hermit for a while. He focused on maximizing his savings and lived very frugally for how much he made. And every single penny that he could, he was plowing it into his high conviction. It worked out really well. Again, his thesis was very sound if you actually listen to it. And I feel like a lot of people understand this thesis now, but there was just not enough, capex investment. And if you still think we're going to need oil for at least 10 years, well, we're not going to be able to produce enough of it at one point. And you know that, for example, a lot of these oil majors, price has to go down to like below $40 a barrel before they start losing money.
yeah.
And even if we see a pullback in oil, they're still going to making tons of money. So, but anyways,
Yep.
that kind of goes to show for at least even I feel like that too right now. I mean, every dollar I have invested, what am I buying? I sold my oil majors, but right now what am I buying? I mean, we can tell the audience, they probably already know I'm buying big tech, and I'm buying some real estate. You know about the real estate one. I haven't made a video on this one yet, but
Yep. 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 Um, okay. So just out of curiosity, like from like again closing out portfolio and risk, if a person were to rebalance with more so risk in mind, how do you think they should go about it? Like especially when you consider that rebalancing timing luck
hmm
may be a thing,
hmm
or
yes.
or I guess your thoughts on if that's even an issue at all to begin with.
So for some reference for our audience, define portfolio rebalancing luck.
Oh, okay, all right. So there was a study that was done, and I've posted it in the deluxe chat. It's an older one, where like an index that was like more value focused. They set up an arbitrary date for rebalancing annually, and the date that they chose was not the exact bottom of the '08 financial crisis for stocks, but it was pretty darn close. And the academics that did the study, and it's in the Discord, um, what they found was if you chose any other month at that specific date, your variability could be about like a 10% swing, which is, I'd say significant enough. So to say that rebalancing timing luck may very well exist. Like we can't fully, at least I'm in a position where I wouldn't like disprove it. So, for those that have more of a risk focus in mind, should rebalancing be done, and if so, how? Obviously, there's nuance such as the individual transaction costs, tax considerations, and so many other things.
Yes.
Like, yeah,
Ignoring taxes, which oh my gosh, but
yeah,
ignoring taxes for a moment, I would say that it goes back to that strategy I have, which where it's like a range. So, because it's my realization. So basically, when I was younger, I realized that very thing. I don't want to be the guy to draw the line in the sand, say I'm out or I'm in at this price.
yep.
In fact, actually, let's talk about a recent, let's say, failure in optimization that recently happened to me this year. Let's talk about it because I feel like this doesn't get highlighted enough, and that's global payments. We can talk about that, right? What's the failure there? I didn't follow my typical prep plan. What did I do?
Oh, I'm not 100% sure, but you actually deviated. Huh.
It's yes, exactly. I deviated from what I normally do. And guess what happened? I learned my lesson yet again there. So, and by the way, this is the beauty of the YouTube channel. This is recorded, documented. I've made that error, right? So for the time being, because it's an optimization. Did I pick a good company? Check.
Yep.
It was it a good price? Yeah, I think so. Check on there. Was it the best price? No. What could I have done better? Well, my normal strategy would have proven successful had I followed it. Because exactly that. What did I do that was incorrect? Drew a line in the sand. What is Bacon discussing here? Well, drawing a line in the sand is very much about luck, right? We don't know when the exact bottom of whatever that we're discussing is. We don't know when the exact top is. That is the equivalent of, again, drawing a line in the sand. You're making a claim of let's say that is what it is because I say so. I think it's a losing strategy. I feel as an individual because I'm not, I don't have the crystal ball. I feel like the best strategy for me, and again, I will continue to follow that, is to do the range strategy for me. It works. It works really well. It's worked in the past pretty much for any investment that I've applied it to. And it also gives me time to digest. It gives me a lot more time. And it was strange looking back as well because I made a lot of content talking about demand destruction, all of these other various aspects. And yet I did that with GPN. Had I followed that strategy, it would have given me even more ample time because I feel like you also need time to look at it, right? So
Mm,
when
yes,
the position is inside of your portfolio, it is different from when it's outside. I feel
I
like
I agree.
yes, it's different, and you start to really think about it in a whole different light, and you can't fight your psychology. You have to work with it. It's like that roommate that's chained up to you. So if we fight our nature, we're going to fight a losing battle. And I feel like everyone needs to discover what it is their nature is, and then don't try to fight it. Work with it. Work around it. Tame it to your own desire, right? But understand that it exists and master it in that way. So with global payments, I mean, right, it makes no sense, right? I make all this content saying there's going to be demand destruction in 2023, late 2022, which pushed it back a little bit to 2023. We're seeing perhaps a lot of the liquidity crunch, for example. And yet I'm like, yeah, this is the bottom for global payments. Buy the full position. Makes no sense. Makes no sense. Went against completely what I was saying at the time and my traditional strategy. So I think that's a really important point to point out a mistake that's again documented on the YouTube channel. And I'll tell the people now. I actually joke like everyone else, like the new trend, the new craze is tax loss harvesting. I tax loss harvested GPN against some of my gains this year. So you guys on YouTube, if you're watching this, you guys don't know this yet because I haven't done a portfolio update, but yeah, you'll see that. So
All good. Okay, so we can close up portfolio and construction and risk in this interview. Next topic, I guess, would be options or other complex financial instruments. And watch as everyone floods in and everyone rushes out. All right. So how would you determine if an option is more attractive as opposed to the underlying or yeah, just the underlying in general?
Wow. Well, for one, the confidence level has to be incredible. So I have to be in what? Well, confidence is the first part. So step one, I have to be very confident in the timing of it, because we can talk about the decay of time, and basically the
Certainly.
amount of, like, you're not just betting the stock's gonna go up. You're betting the stock's gonna go up by a certain amount in a certain time frame. Like, my goodness, like wow,
The audacity.
the audacity of such a claim. If you buy the common stock, you're just participating in whatever economic future that stock has to happen. You can be patient. You can afford to wait forever. You could have bought, Microsoft in 2008, and you could have just waited for the market to catch up with the economic reality of Microsoft. But if you had bought options, and you're probably dumbfounded. You were probably like, well, Microsoft's growing every single year. Their business is incredibly sticky. You're right on all accounts. You're right on all accounts, but your timing is off. And the market can be irrational longer than you can stay solvent. Well, that's the case for shorting. That's also the case
Very
for
true.
buying an option. Because the reason why shorting is because shorting has a cost. Shorting has a cost in the sense that you actually have to pay interest when you short. So there's a time cost. The total time that you're short, you're technically also having to be right on the timing of it. And not technically, literally, you have to be right on the timing of it. Michael Burry's bet almost brought him to bankruptcy. His fund was crippled, and he was paying tons of fees, but he was right, and he just, you could say, ascribe it to luck that it happened at the time it did, and he was able to make a lot of money because if it, let's say, the bubble had prolonged itself for another good 4 years, we'd be writing a different story maybe. Someone might have captured it, but maybe not him. But he was right. So
Yeah.
options, yeah, difficult.
Yeah. Uh, so I guess more in line with the spirit of options originally, as insurance, as many people would say. Like, is there an approach that you have to use options as a hedge?
So if it's a very big thing is, though, my gosh, what am I saying when I do that? When I do that, I don't have confidence in the business I own.
Mm,
And I might be playing a little bit too much. And I like to say, like, this is where I say it's like the art side. For me, I know how I think. I don't want to be too involved with the position after I'm in it. I want to kind of take more of a step back approach. So let's say, for example, you guys know that Alphabet was a large position in my portfolio. It still is, but like it was the largest for a while. And okay, well, earnings are coming up. Well, I'm not so confident in these earnings, Bacon. I don't know what I'm going to do. Okay, so I'm going to buy some put options because I want to hedge against Alphabet going down. Well, why would I do that? All right, why would I do that? Well, because I'm making a short term bet, so it gets back into that. I think the incorrect mentality for me, but that's for me, where I'm in Alphabet for the long haul. I don't want to play or stress about what's going to happen in that report that could drive the stock down or whatever. Of course, optimization. If I would be lying to you if I somehow knew that it would, if I somehow knew 100% certainty that it would, of course I would take the bet to the downside and then redeploy it back into Alphabet. Of course I would do that. But what why would I take the chance of it, right? Because I really don't know, and I don't want to make that bet. Now, there is, I guess, a place for it, but usually when you're kind of doing that, maybe it's because you're already in a degenerate position and you're trying to protect your downside on that same degenerate position. So that basically what I'm saying is if you're in one of your solid, what you believe to be solid long-term investments, I wouldn't be doing it for that. But if I'm in something that, oh, quite literally, if something were to go wrong, permanent loss of capital is a very real thing that could happen. Okay, okay, well, that's a separate conversation we can have. And maybe it makes sense for that one. Okay. I'm trying to think of an example because usually I don't like to participate in them, but um, let's see. I mean, we could say that you have another options position and there's, let's say, some movement and you have some gains that you could realize now, but then you take another position that would shield your downside at this point. Okay, maybe, right? Maybe you could be talking about that because yeah, if you're wrong or you want to hold the position for a little bit longer and that could be the difference between, you making out like a bandit and you losing the whole position. Okay, maybe, but yeah, I'm struggling to find a real world example in which case I would feel the need to do so because I typically don't want to participate in those investments.
Yeah, it's all good.
So,
Yeah, because this is like purely an interview about you and your process. So yeah, not a problem at all. Just out of curiosity, like, do you have like any thoughts or like a unique mathematical approach to like options Greeks?
unique? No.
No.
No
Uh,
unique approach.
okay.
Let's say I genuinely prefer, this is separate from, let's say, the Greeks, but it's implied in the Greeks because, like, well, all of this is already known public information. So you are competing in a marketplace and you're trying to figure out something that's better. Like I said earlier, I don't even think about participating in the options market for the types of entities that everyone's paying attention to. I feel like that's too hard of a game, right? It's too hard. You're going to be playing with the soap. You're more likely to fail than succeed. Even like, for example, people think they found, I don't know if you want to kind of turning the question back on you because I'm curious how you feel on this. How do you feel about people who feel like they've just discovered the golden goose, right? The golden goose that lays the golden egg and they sell covered puts,
Oh,
cash
I feel
secured.
terrible. I feel terrible. Like, I mean, I get like from selling a covered cash secured put or a covered call, like the strategy behind it. Some people really like that premium, and I'm not gonna outright dismiss it. It's just that wow, you really should consider a lot of the details, because so much can go wrong, and I'm just a moron. Like I don't even have a mathematical approach to the options Greeks myself. Like I have my own like rinky dink Black and Scholes model like on an Excel. But like I have zero faith and confidence in that thing.
Yeah.
So yeah. I would just caution people in general, me personally.
You remember what I
Yeah,
said earlier in the interview about you're competing against entities that have way better
yeah,
information than you and
yep,
I have access to? In the
yep.
options market, I really do ascribe to that you are then at that point competing. And if you are successful, a lot of it can be attributed to luck, especially in the names where there's a lot of participants. A lot of
Uh,
participants. Like you're playing the options game in Apple, you are a complete and utter degenerate. And if you think that you're just the success that you're getting is completely attributable to your skill, no, uh, you you are more like when the market is basically pricing in the options market, and actually you could probably use the options market to kind of feel for what the market is believing the movement of that stock is going to do. By the way, that's something I actually do use on occasion. So I'll look at what the options markets are pricing in for a specific stock. It's not as good as other indicators. It's not the best indicator, but it's something. And when retail gets involved in cash secured puts, they think they've become I don't know, the bank. They become the casino, as some might say. And
yeah.
that's really misleading or that's really misguided. And if you feel like you're getting a great deal, you're probably not.
Yeah. Oh yeah. Yeah, 'cause like even in the relatively benign scenario, like say I sell a covered put on a company that I really like and want to be exercised on, it could very well be the case where, it hits that strike price or goes in the money, but then like, the time hasn't expired, price jumps back up, and all I'm left is just holding premium. Like, okay, congratulations.
Precisely.
Yeah, it's definitely not a perfect thing. Like the outcomes need to be considered for sure. Um, okay, so just out of curiosity though, like how would you when it comes to options, like when do you think the market is wrong, like as far as like from a delta being overstated or implied volatility being too high perspective? Like, do you have a way of determining that or no?
When I feel the market is wrong,
Yeah, the options market specifically.
well, the thing is, the options market is going to be really reflective of the sentiment of the stock at that time. Um, so it kind of goes hand in hand with how I feel like the market's wrong on stocks, on the stock
Yeah.
price.
Mm.
I can give you an example. Meta, pretty
Yep.
recently, Netflix, pretty recently, on that massive move, draw downwards. I feel like if you had looked at the options market at that point in time, not right now, but at that point in time, for a brief moment, I feel like you could have basically seen just crazy either. I think I'm pretty sure because I don't have a snapshot of it, but I'm pretty sure had you looked at those two companies at that point in time, there was a lot betting that it would continue downward.
Ah.
So, because a lot of people were seeking insurance, let's say, let's call it that. A lot of people were voting with inside the market, saying, "I need to cover myself here." Oh my goodness, like what is going on? And you won't probably see that often in like the short interest of the stock. Like there's not a lot of people shorting Meta stock or
Yep.
Netflix stock at the time, but there's a lot of people probably buying quote unquote insurance in either direction. And you probably would have also seen in the call options market a little bit after that, perhaps when the market kind of digested everything, the reverse of that. So I don't have again that screenshot in front of me, but I guess if we went back in time and we looked at it, or we looked at the data, we probably would have seen something similar to that. But it goes hand in hand with the sentiment of the stock itself. I feel like there were tons of people, just fund managers, retail, all saying these two companies are terrible companies. So usually that's you're going to see that reflected briefly in said markets, like the options market too. So
And since this is options and other financial instruments, are there any other instruments that you're comfortable with or would like caution the viewers on? Like maybe say like futures contracts or
yes,
other
yes,
more things, other things.
yes. So the average person, 100%. If you already conclude that the average person shouldn't even be invested in individual stocks, they shouldn't even have think. They shouldn't even have thoughts of options, futures, shorting, any of this shouldn't even come across their mind
Yeah.
whatsoever. Leveraged indexes or ETFs, my goodness, yes. So if you're asking me about caution on futures, like well, futures you have the added benefit of if you want to like capture the movement in a commodity. Oh yeah, you can right there.
Yeah.
So even though I have videos saying I believe oil, when I have the videos talking about why I'm selling my oil positions, a lot of it was predicated on demand destruction that oil would go down. Did I partake in that trade? No. However, if I was perhaps like let's say again giving prescriptive analysis or selling prescriptive analysis to let's say a fund or something like that, that would be maybe a different story because it could be like a pitch of sorts. I think this is going to happen, and then but it has to evolve from there. It has to there's a lot of work that has to be done to kind of position it correctly and try to mitigate as much risk as possible.
I
Um,
know.
Position sizing, etc. Something that retail unfortunately will seldom do. So
Yeah. Yeah. Position sizing and path versus terminus with these more complex instruments is yeah, generally speaking, probably what like a team of math PhDs and at least masters. None of those I have. Okay, so yeah, we'll transition out of that. Just out of curiosity, like what let's do like a uh industry like sector or subsector like run through. Like what are some of the things that you first look at? And what are some of the things like from an accounting perspective most people don't consider?
uh, you want to go? You want to ask me about a specific sector or just all sectors as a whole?
All, or at least, the ones you feel comfortable with for efficiency's sake.
Well, I'm trying to think it through because each one has like their own nuance, right? So
Yep.
for example, real estate is going to be you definitely wouldn't look at earnings because of what it is that their main business is, which is real estate. So there's going to be a lot of depreciation expense, and it's not really a true capture of how the business operates. You want to look at, for example, FFO, funds from operation, which is another way of saying like the cash flows, but adjusted for real estate. And you want to also then look at the book value, but be careful about the book value because the book value is actually a very conservative measure for that entity. And I feel like people don't really appreciate that because it's very different in accounting to say the book value versus the market value. Those are two different things.
Very. Oh yeah.
And you got other when you find a business, this is not specifically sector, but when you find a business that, let's say, has very low price to book, be very careful what's on that book, right? What if that book is a lot of goodwill, you know?
Yeah. Oh
So
yeah.
maybe look at tangible book, right? So it's a matter of nuance there. But sector analysis like banks, financials, typically a very difficult one for a lot of people to gather. I think there's a lot of qualitative analysis that goes into it, more so than others, and the value of the book. Because there's the book value of the book, and then there's the qualitative measure. So, for example, we all know we can all come to an understanding that personal loans is a very bad loan to hold, especially in a downturn. Especially in a downturn, very bad loan to hold. So, let's go a little bit further, like mortgages securitized by the house the person lives in. Oh, okay, that's higher quality. You're going to get a lower rate on it, but higher quality. So we can make a good determination there. Treasuries, very good. Let's see, another one we can think of is car loans. Not that good. I already said personal loans, but you can gotta get a feel for that. So you want to make sure, like say the bank that you're looking at, what are they holding, right? And of course, the higher up on the risk curve that they are, they can generate higher interest margin. And a lot of these banks with high interest rates in their savings account and checking account, because maybe they're, obviously loaning it out at a higher rate than what they're giving you. So maybe that's a sign to begin with. Also, it could also mean how much do they want new deposits? Because they're basically going out into the market and saying, hey, we really want more deposits. We're willing to pay 3%. Right.
Yeah.
We're willing to take a lower net interest margin. But another one that I can think of, as far as, tech companies, right? Tech companies, a lot of them have a lot of stock-based compensation expense. You want to make sure, pay attention to that. They're going to highlight to you the cash flows, the EBITDA. But what does it matter to you if what matters to you as the owner is a couple of things, really. And it's really having to do with how much money is left over after everything. And if the money that you have left over is only there because you're giving up ownership, you're selling your ownership. Well, remember, I even said this in the dividend video. When you're selling ownership, you're selling all of the future economic potential of the assets that are held under that entity, right? So it's actually far more costly than you can imagine, than just the cash.
Certainly. Alrighty. Da 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 da. Um, how would you say like is a way for someone to get better understanding of each business cycle for each industry? Like, is there a way for someone to improve on that?
Um, there's no magic pill, but
Yeah.
it's time. It's time and time in the market, time in that sector, time involved with those companies. You can hopefully find someone that is very familiar with that and they can speed your process along, but that's basically all they can do is speed your process along and understanding that. And this is why retail is going to have a very hard time with cyclicals, very difficult time, because they can be very difficult to determine what part of the cycle they're in. General rule of thumb that I can do to help speed someone along, do my part in whoever's journey is listening to this. Cyclicals will look expensive when they're cheap and cheap when they're expensive. So that's kind of like a general rule of thumb. There's more research that needs to go into that, by the way, because, oh my goodness, someone just goes, oh, this is a cyclical business. Oh, the PE is like 30 and buy. No, please don't do that. But generally, you would have to have a better understanding of like where it is in the economic cycle. You know, for whatever research you've done, that in the next coming years, business is going to be booming. And so right now, business is not booming. And right now, the PE is, let's say, 15, 30 or whatever. And then in those times, the PE is going to come down to like 5. And that's when retail is going to go, oh my goodness, this is cheap. It's a PE of 5. I should buy this stock because I learned in math that when the number is small, it's cheap. And then they fall for it because, again, everyone knows that. The whole entire market knows that. And that's why it's cheap. that's, that's why it's still not at a PE of 15 or 20 because the market's telling you, hey, next year, earnings are going to collapse by 50%. And you're going to go, oopsie. I, I have a video for everyone to watch. It's the Micron videos. Go watch the Micron videos. I talk about the accounting, how the earnings aren't showing you, for example, the cash flows. I made a bold prediction that the earnings are going to reflect the cash flows into the future because in some of the accounting nuance there, it's the point of where they recognize the revenues. Revenue recognition. We recognize it on the accrual basis of accounting. So right now, the earnings for Micron look, it's cheap. It's a 6 PE or whatever it's trading at now. But look at the cash flows. I think Micron, what did they most recently report? I think they something came out about them recently. But I feel like the only people who are going to be truly surprised, yeah, they're down to about $50. Book value's at like 45. The only people truly surprised who don't understand the nuances. I mean, when I made those videos, Micron was significantly higher. And now people are, I guess, waking up to that reality. But
Yeah. Um, Alrighty. So that's a good closeout on that section. And the last one would be evaluating weaknesses and yourself and what you've observed within the capital mindset community. What would you say are like your weaknesses as from investing or possibly like trading? And what are some things that are outside of your circle of competence and probably will stay out there for a while?
anything that is fashion related, I stay out of. I am definitely not a fashionista. I do not understand that market. When I participated in one of the investments, um, although it sucks because I actually was sort of right, maybe right because there was COVID and stuff. But it was on L Brands, a company I had invested in L Brands, and had I held it long enough, I actually would have generated a very good return. But I didn't understand the fashion trends of what was going on. For context, L Brands doesn't exist anymore. They spun off Victoria's Secret, but they used to be Victoria's Secret, Bed Bath and Beyond. Sorry, not Bed Bath and Beyond, Bath and Body Works, and Pink. They used to further than that. They used to be limited brands, but I thought it was buying almost like a cigar butt investment. It was cheap, but anyways, retail, unless it's like super high end, I don't really understand it too much because that's very much playing on the shorter term consumer trend cycles, which
Ah,
I really do not get. I really don't get. I am not in tune with like, oh, this is in now. This is not in now. But I can kind of get behind, for example, giving some names, LVMH. LVMH buys or owns a lot of brands that are long lasting. They're beyond just the current trend. They're 100-year-old brands, and they work really hard at doing that. Like for example, you'll never find a Louis Vuitton bag on discount. They'll destroy the bag before they sell it on discount. And Ferrari is another example. Ferrari, even if we go to electrification, will always, even more than Lamborghini, carry the brand name above and beyond what other cars even care about. They purposefully restrict supply, and they don't just sell to anyone. For example,
oh
you
yeah.
have to, those things I can understand. I can understand Apple. I can understand that, but I can't understand right now people are weight conscious or not weight conscious or I and like that's like maybe a 6 months, a couple year trend. I stay away from that. If I were to participate, that'd be like a maybe a speculative position, and I'll participate in that. I also can have let's say, I have a weak spot for restaurants. I think restaurants is another one I don't quite get. I don't quite understand them too much. I don't like them too much. So if I've and the weakness, I guess, from an investing standpoint is sometimes I forget that I have no competence in that, and I try it anyways.
Oh,
Forgetting our previous confessions and just going about it. So that's again beautiful part about the capital mindset community is now I'm with a lot of people that are all of different backgrounds, different mindsets, and they can help me in maybe even finally understanding some of these points, right? Because maybe there's someone out there, I guarantee there are people who do understand, let's say, these shorter term consumer trends that I don't. And they can explain it to me in a way where I'm not simply, let's say, even if I still consider it a speculative position, I'm not going in there without at least a candle, right?
yeah.
Or what I think is, normally I think I have a candle and I don't. I just the candle's off completely. But yeah.
Alrighty. What from what you've observed of people, what would you say are some of the weaknesses? Well, we already covered indexes and passive, but how about weaknesses for like more of an active style of stock picking?
Oh, this goes back to I think I have a couple videos or live streams and videos on this, which is the spectrum of the story driven investor and the analytical driven investor. And you don't want to be one or the other. You want to be a mix of the two.
Yeah.
And pigeonholing yourself to a strategy. I
Hmm.
feel like I am right. Obviously, everyone thinks they're right. But what I mean by right, I think investors should just be investors. I feel like I don't like to say, "Oh, I'm a value investor," and I've been called a value investor by the YouTube community, even though like I'm holding like Netflix and I don't agree with that. Maybe they didn't see my portfolio. Maybe they just prejudge based off of, let's say they see I use a valuation method, and they're like, "Oh, he must be a value investor," because they've been clouded by other content creators. And I get it. They're fairly probably new to the market for even saying that or suggesting that, but. Um, I feel like pigeonholing yourself into one line of thinking is going to harm you more than help you. Um, Although figuring out the strategy that works right for you is, I don't consider that pigeonholing yourself. I consider, coming into this and saying, I'm a value investor before you even know yourself. Because it's a journey, you got to get to know yourself. Um,
Oh, yeah.
don't allow yourself to listen to someone else. If you're listening to this and you're new to the markets, don't allow you listening to someone else color your viewpoints as to how you then come into the markets. You got to it's quirky, I know, but you got to find yourself. It's true. It's a true statement. You do have to find yourself, because my style can be very different from what your terminal style will be, your end style will be, and your style hopefully is what keeps you engaged, motivated, etc. So some people are dividend investors. I will not, shame someone for being that if that's what they've learned throughout their lifetime that keeps them in the game, keeps them excited, and keeps them involved, and they can understand a business as long as it's doing some action, right? I get it, but that's, I think, the weakness of the individual investor. It's first not knowing themselves and pigeonholing themselves, kind of coming into this into one specific textbook strategy where they're not going to find success.
Um, Alrighty, and this one will probably make me lose a lot of friends. Weaknesses from different backgrounds, like what would you say are like some of the weaknesses for say someone with more of a macro approach or background, an accountant, or someone that's more amateur or generalist, or someone that's more academic, or the ever loving ham bro, total
Oh my.
addressable market bro.
Yeah, my goodness. Okay, so talk about pigeonholing. This is definitely the biggest example of pigeonholing oneself. So let's go in the list. So you said first the macro, right? Macroeconomic
Yeah.
people.
Yep.
Well, I don't know many who have made absolute killings off of going from that base, because for one, that is definitely like drawing a line in the sand of understanding of how the market system works. That is, you're basically making that statement. If you're going to invest based off of just solely that, we're assuming, by the way, we're all these groups. We're going to talk in isolation of investing based off of the principles that the character I can't say the word caricature follows. Okay, so the economic investor, their macroeconomic investor, just follows that and doesn't follow anything else. So that person, if they exist, which they do exist, but that person is basically claiming that they understand the system. And the probabilities that they do is very little, because if that was possible for one person to know the system, then in that case we have a situation where that person should just run the country. That person should we should just give them all the power, and they'll just handle it. They'll just handle it because they understand how things work. So fantastic. But that's not how things work, right? That's definitely not
No.
the case. So,
Yeah.
and then the next group, the accountant background.
Accountants. Yeah.
Too much looking at the past is what that will cause. Far too much
No.
looking at the past, not forward. So, the there's a term that's supposed to be, like let's say attacking accounts, but they call them like bean counters, right?
Yeah.
And of course, an accountant's far more than a bean counter, and an accountant is capable of looking forward. For example, there's like different types of accounting licenses. Like you can get a CPA and you can get a CMA, right? So the CMA is probably more characterized as a forward-looking accountant versus the CPA is more like backwards-looking accountant, compliance and all that, but learns and understands construction of financial statements to the T. Not that a CMA doesn't, but that's how I would define basically CPA versus CMA. So a very basic explanation. But the accounting background can pigeonhole you until just looking at the past and making judgments on the past of a business or the current state of the business. And that's good. That's important, by the way. Understanding the
Yep.
current state of a business is extremely important. And looking at the backwards rearview mirror of a business is also important to kind of look at track record. But yeah, that's the weakness of that. And the next one's going to be very controversial. Oh no.
For the generalist, for the amateur.
Or more academic.
Oh yeah, and the more academic. Yeah.
So so the amateur one is not going to be controversial. The amateur one
Yeah.
is going to be presuming mastery of something without having mastery of it. And I'll just say this: if you're starting this, you're never going to be a master. It's never, because actually, fun fact, this is what makes it terrible. So as soon as you figure out something, like let's say like as soon as you figure out the macro system, let's say you do, how would it sound? What would it sound like if I told you that description of the financial system will be true only for about 5 years, and then within 5 years it's going to be totally different? Yeah,
I mean, make sun while the while make or make hay while it's sunny out there.
precisely. You're gonna have to. So
Yeah.
basically, what I'm saying is like you're always an
Yep.
amateur. There's just a spectrum of amateurness, and
Hmm.
you're always gonna have to be learning. That's what I'm trying to say with that.
Yep.
Always learning. We're all amateurs. There is no master, and we're just like anyone who's gotten some level of success. It was just for a momentary period, not an amateur. But then in a couple years, maybe months, they're going to be an amateur again. But it's realizing that, and you keep moving forward. You keep going to the next thing, the next thing, the next thing. More learning, more learning, more learning. New industry, new changes going on in the system. Something goes on there, and you kind of have to figure out how does that affect that. So it's constantly learning. And then the ones who say they're stagnant, they say, "Well, I've learned everything." Well, no, that person's that's in the spirit of the question. That's a true amateur, and there's nothing to be helped for them. They're done. Like if someone comes to that mentality, you're done. You're not going to be successful in the markets. I can guarantee you that. You have to always be learning. And then the last one, or you said Tambros? Did you say Tambros
Yeah.
again?
Yeah. I said Tambros.
Okay, so second to last one, the academic types. The
Yeah.
academic
Yep.
types follow basically, they're almost like the people who are saying they understand it, they understand the system. And oh my goodness, can that really harm you by saying that and then acting upon it. There's something to be said about act or saying it. You're an armchair economist on the internet and you're just typing away. I feel like there's a stark difference between money managers and professors, for example, who teach the topics. It's very important that they exist, by the way, because they help shape the future generation of money managers, the future generation of people who will further understand them more than them. And they're supposed to teach the foundations, the history of it. I like to think of the academics in the finance and accounting space, or more the finance space, as the historians. They're the historians of finance. The economic professors, they're the historians of economics. They're describing the system as it was, hopefully. And from as it was, they make theories as to what might be or what we can do to do something else. I really don't like, you see the controversial side, like, you can have a PhD, et cetera, and that will not make you a good investor. That will probably not make you a good investor. And oftentimes you'll see that some of these PhDs, very good ones, by the way, the ones that people pay for, because there's the ones that, okay, they teach at a university. Great, right? They're very intelligent people. But you don't have, like, let's say, where money matters, you don't have like a practice or a fund breaking down the door and saying, we're going to pay you exclusively right now. We need you to conduct some research and do a presentation for us because we really want to know what's going on and we feel like you really understand what's going on. When money matters, there are a lot of PhDs that do that kind of service. They provide that level of research. But even them in isolation are not the full picture, and just by themselves, that's why they're not trillionaires, right? They are just like a piece of it, and you can't expect a single person to be the full, complete picture. It's again kind of you're building a community. Either you pay to build that community, and let's say that network, or you happen to come across it and you're friends with those kinds of people. But sometimes you need to find people who can help fill out, let's say, a blind spot for you because they understand that specific part of something. And they can fulfill that for you. They can be an academic. And and it's kind of like the difference, again, between industry and academics. Now, the Tambros, oh my goodness, where do I begin with them? I assume you're talking about the Tambros and say, look at the total of addressable market, bro. Those guys?
Oh yeah, yeah.
Well, man, there's not much to be said about them. I'd say that hopefully they learn that that's advertising. And that's all I have to say about that.
Okay. All right. So I think you also like in the process of this covered like strengths of a lot of these categories. Did you want to run through anything else on that? Because I was going to actually like add a general one
Go for it.
or
Go
a
ahead.
general spin on this. Yeah, yeah. So what would you say is like the greatest strength for a retail investor for anyone that's in this journey?
Time frame, lack of
Yeah.
pressure. There's no one
Mhm.
breathing down your neck. When you're a fund manager, when you're a analyst at a fund or whatever, there's someone breathing down your neck. There's performance you have to commit by. As a retail investor, you can be doing whatever it is you want, your day job, whatever it is, however it is you make money, you're doing that. You're getting new capital coming in. You can afford to be patient. You can afford to do nothing. You can afford to take a hiatus. You have that optionality. Like tomorrow, any member of the capital mindset community, which I think the majority are not working in industry, tomorrow they can close their phone, turn off their phone, close their laptop, just stare off into the sky and relax, take a breather, not come back to the markets for like a month. If you work in industry, you can't do that unless you're the fund boss. Then maybe you can do that. But no, if you're one of the grunts, yeah, you can't do that. And also, what you guys can do is say, all right, I'm gonna take a step back, take a moment, pause, and not analyze stocks or take my time. I'm gonna take my time analyzing this company. No, you have deadlines. So, and also you have to worry about the year-to-year performance because that's how you get paid. So you don't have to worry about that as a retail investor. All of you listening, retail investor, you don't have to worry about any of that. which is actually an advantage of a family office. A family office, kind of in a similar sense. Family office is kind of like investing like a retail investor, but at scale. Um, and you don't have, as a family office, anyone breathing down your neck because you're in a good position where you're basically very wealthy and you can just, you're your own boss. You invest how you want. So that's a really good position to really be in. You don't have to say, oh no, I didn't make this percent this year. I don't get my bonus. No, no, you can afford to be like what Buffett says. I think Buffett provides a lot of wisdom that people don't really pause and truly absorb, like waiting for the perfect pitch for you to swing the bat. Retail has the added advantage, huge advantage. It's a big advantage that they don't have to swing. So
Yeah. Oh yeah. Man, I struggle with Buffett. Like there's a lot of wisdom there for sure. But also at the same time, some of it where some things where I find myself thinking, yeah, but you're Warren Buffett. Like you were able to, redirect cash flows in some cases and, take over businesses when needed. Like I can't do that.
no, for sure. Yeah, he was able to because he has the float from the insurance business.
Oh yeah, yep.
Yeah, there is something to be said. Like for example, if you have there has to be something that is bringing capital. I feel like you can't just be a quote unquote investor unless you have tons of capital already. But all of us pretty much have ways that we're securing capital, making money, and then we're grabbing that capital and redeploying it. So that's not our float. It's not the same thing, but it's still something that like we're not just a pure investor. I'm not just sitting around and just only moving money, and that's how all the money's coming in. I have other passive, let's say, businesses, investments, work, salaried income. All of this contributes to that, let's call it float, and then I redeploy that float into my investments. But yeah, the average person doesn't have an insurance company. They can do that. Most people, their quote unquote float is their salary, and
Yep.
that's after expenses and etc. But
Certainly. That is a good philosophical point, and I think I'll close off on my end I was like, what point do you think it was unhelpful for people to, like think things are investments rather than savings? Or, is that even a topic? Am I just,
well,
overthinking things or
no, you're not overthinking because there is some people who treat their investments as savings, and no, they're not at all. Savings is there when you need to spend it, but it needs to be able to spend it. Investing is there. This is really going back to Buffett, but going back to everyone. All of the investors have a common message. When you buy a stock, and it's so difficult for retail to wrap their heads around because they've never owned a small business. When you buy a stock, you have to think of it as an owner. And I really find the difference when I find someone who, and by the way, it's I think going back to one small criticism of index investors is they tend to never think in this philosophy. I seldom find them thinking this way because they're buying a product at the end of the day, and that product invests in those companies. But I get it why it's difficult to get into this mindset because you're not intimately interacting with any of these businesses. You're kind of just beep boop, dollar figure go up over a long period of time process. But when you own a small business, right, or medium size, whatever size business, but you're the owner, you don't think at all how a lot of retail thinks. You don't even think about selling half the time. Like that's not even a thought that goes through your mind. Like, that never goes through your mind, actually, if you really think about it. I have shares in a small business that, well, I guess it's more medium business, but I have shares in it. Never has it come across my mind to say I need to find first of all, it's a hassle, right? I got to find
oh
someone
yeah,
with the capital. We got to
yeah,
come to an agreement about what I would sell it for. So it's already a big problem. It's not like I click a button and it's gone. But I never think about selling it. It doesn't even come across my mind that it's a business that I'm going to liquidate the shares and get the cash at all. Doesn't come across my mind at all. And that's basically almost like I'm forced, not forced. It's natural to just think of it as a long-term investment, but in the truest of sense, it's a long-term investment. I don't look at it as a savings account. I don't look at it at all. I look at it only at the fruits that it can bear for me in the future. and I can, I can enjoy the fruits of that, and that's about it. But a lot of people, I know that they look at their investments as their savings, and if an emergency happens, it's normal to draw upon it. No, that's quite literally a bad emergency, because unfortunately that person didn't. It could be a very bad emergency out of their fault or whatever, but let's say it's not. Let's say they don't have a savings account because they're like, oh, I don't have a savings account because I'm going to draw from my investments. I don't feel like that's appropriate mentality to have. I think you should be having the separation. This is savings. This is for an emergency, and then this is my investments. I'm not supposed to be even considering, drawing from this. But yeah,
Alrighty. Um, Thank you very much for your entire time in all of this. This is a long interview.
oh no worries. These are
Yeah, I mean, yeah, it's Christmas Eve though.
oh no, this is still fun. I love talking to the community. So, and you've been a long time member of the community. So
Oh, yeah. I don't know. There's longer though.
there's longer.
Oh yeah, yeah. Like I discovered you guys like tail end of Austin's time or as Austin was stepping down thereabouts.
Oh, but that's still pretty early on. That's still before 1,000 subs. That's at like 600 subs.
Yeah.
So the first 1,000 are I would consider the OGs, right? Because because I feel like this part's I'll keep it in here because it's interesting to note for everyone. I think the first 1,000 is the most difficult to surpass because there's like a psychological aspect for people where it's like, oh, it's a channel of less than 1,000, and I'm not going to subscribe to that. But it's easier to subscribe to. There's a name for this phenomenon, but I forgot the name. It's easier to subscribe to a channel with, for some reason, a couple thousand subscribers. So there's like a
Yep.
snowball effect of
Yeah.
growth that
Oh
happens.
yeah.
But yeah,
Yep. Anyways, I guess yeah,
close it off
I'll
there.
say Merry Christmas Eve, Fabio, and to your household, friends, and family. I wish you and yours the best.
No, no worries. Thank you to you as well. To you as well. And I'll end the recording here. Thank you guys so much for watching, and I'll see you guys on the next one. Bye.